Are you in for a treat today? We have as our guest the head of the local Bogleheads chapter, and we're going to learn all about a simple way to invest here on the LawyerFi Podcast.
This is the LawyerFi Podcast, equipping lawyers and other high-income professionals to reach financial independence. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.
Welcome to the LawyerFi Podcast. I'm your host, Adam B. Cordover, and we are here teaching lawyers and other professionals how to reach financial independence. We're going to be doing something that is a bit different for today's episode, and I am so excited about it. We are having our very first guest. He is the coordinator of the Tampa Bay Bogleheads chapter, as well as the co-coordinator of the Bogleheads Retired Life Stages chapter. Alan, who I'll introduce in a moment, is a retired anesthesiologist. He retired in 2018. He discovered index investing in 2008 and the Bogleheads in 2013. And don't you worry, we're going to talk about who the Bogleheads are. He's gracious enough to discuss his personal investment. So just for privacy purposes, he asked us not to use his last name. Nonetheless, we are so thrilled and excited for Dr. Alan to be joining us today. Welcome, Alan.
Thank you, Adam. Glad to be here.
Absolutely, absolutely. So I'd like to start out just hearing a little bit about your family background when it comes to money and whether money was discussed. Do you mind talking a little bit about that?
Sure. It actually really wasn't discussed very much with us growing up. I had a typical middle-class upbringing, actually in a suburb of Detroit. My parents did talk to us about the concept of savings. We all had savings accounts, checkbook savings accounts, and my father taught me the concept of compounding interest. But they didn't invest. They just saved. They basically lived from paycheck to paycheck. And we had an allowance that we tried to save half of and spend the rest. And that was really it. My early, financial education was pretty much limited to that. It wasn't until much, much later that they and I learned a little bit more about the concepts of appropriate investing and planning for the future. So it's been a long, arduous journey, and one that I started relatively late.
And I look forward to diving a bit into it and where it's guided you to this day. And as I mentioned in the introduction, you are a retired anesthesiologist. And so I know a lot of folks incurred debt going into law school and other in med school. Did you incur any student loans as you were planning for your professional studies?
Well, I did indeed. In fact, even undergrad, I had to take out some loans because we had moved from Michigan to Florida, and I went to the first year I had to pay out-of-state tuition in college, and I used some of my own money. My parents didn't save much for college for either myself or my two siblings, so we were kind of on our own. And I worked my way through college, undergrad, with a couple of different jobs. And by the time I got to medical school, I had no money left. I had spent it all. And I had to take out loans for all 4 years and all the way through residency and fellowship as well. I was struggling to make ends meet. Of course, that was back in the 80s. I graduated medical school in 84, finished my training subsequently. But I still had, I think, as I recall, about $80,000, maybe $90,000 of debt when I graduated. And the interest rate that I had in those days varied from about 5% to 7%. So I was really focused when I first started my career. The main goal I had was to pay that off as soon as possible. So I continued living way below my means, as they say, as Jim Dolly, the white coat investor, would say, continue living like a resident, which is what I did. And I put whatever surplus funds I had towards paying down the debt, and I paid it off in about 5 years, fortunately. Nowadays, professionals, whether it be law, medicine, dental, whatnot, unfortunately, the cost of higher education has skyrocketed and people are getting out with a lot more debt. But it can still be managed if you just have the appropriate approach to it and continue living below your means and just chipping away at it. You'll get there.
Yeah. And I think actually that lesson from the white coat investor from Dr. Jim Dolly is excellent. Do you mind repeating that again? Live
well,
like
basically just live below your means and continue living like a resident. Don't fall into that down the rabbit hole of trying to spend your money when you have your first job, when you're getting paid. Don't go out and buy lavish things and try to keep up with the Joneses. Don't fall prey to that. Just chip away at that the loan, and you'll be much better off down the road. It just takes persistence and discipline.
Well, and I know we lawyers tend to fall in that trap ourselves. We figure, we went to school for all that period of time, and finally we got the job. Finally, we got the title of being lawyer after passing the rigorous bar. And we figure, what, we deserve to have that big expensive car and all those luxury items. So it's just really impressive that you didn't fall into that trap yourself, and you were able to really pay down those debts relatively quickly.
Yeah, I think the key is to balance that with the thought that you deserve to have a secure retirement, and keep that in mind. So delayed gratification will pay dividends in the end.
So I think that's great. And then once you paid off your debt, at that point, did you start investing?
Well, actually, I made many more mistakes down the road until I finally became the self-actualized Boglehead, so to speak. The first thing I did that was probably not good is I got married shortly after I finished residency, and then subsequently got divorced after 4 years. So that was set me back a little bit. My ex was also a physician, but we both thought and believed for quite some time that the only way to get ahead and invest as a physician or higher income professional is to hire a professional advisor, and that the 1% AUM fees that you would typically be paying were well worth it to have the professional advice, because they knew what they were doing, they knew what products to use, and they knew how to beat the market. And unfortunately, I pursued that goal for way too long.
And Alan, you mentioned a 1% AUM fee. Can you just explain for a moment what you mean by a 1% AUM fee?
Sure, that's kind of the industry standard, or it has been, is falling a bit now. But basically, if whatever amount of money you have invested with an advisor, that is what the annual percentage is that they will take out of your portfolio for the management. And it seems like 1% is not much at all, especially if they're able to get you more than the market. But it really adds up over time, as Jack Bogle called it, is the tyranny of compounding. And just as compounding interest, compounding expenses also add up, and you'd be amazed. And we have a graphic later on that we'll share that shows the impact of that. The alternatives are to instead get somebody that you pay on an hourly basis for their advice, or perhaps a subscription or a fixed flat fee basis, so you know how much you're paying for the advice. And certainly, as you get the education and learn about passive index investing, that you realize that fees are critical, and keeping your costs low is what will bring you to a successful financial future.
Okay, so you brought up a couple of alternatives, and we'll perhaps explore it later on in the episode, the flat fee or the hourly rate if you're looking for some financial advice, as opposed to a 1% or more asset under management fee. And so you actually have a very interesting graphic, which I'm looking forward to letting everybody know, and we'll describe it for those who are listening on the podcast as well. But you, and I'm kind of curious, at what point did you discover index investing? And by the way, what is index investing?
Well, index investing is basically, let me think if I can come up with a simple, it basically is when you try to capture the market return. You have, say, a total market index, which basically tries to replicate the entire U.S. domestic market on a cap-weighted basis. So the stock share price of an individual company times its market share is the capitalization of that individual company, and an index tries to replicate that by having a basket of every stock, or in the S&P 500 having more or less 500 stocks, domestic stocks, as a holding. And because it's done mechanically rather than actively stock picking, you don't have to have a lot of managers, so the overhead expenses are less, and the overall expense ratio then, we're talking nowadays, 0.03%, 0.04 basis point or less percentages, rather than a 1% or higher fee for actively managed funds. But I didn't know about that. When I was first starting investing, I let the professional advisors manage it, and then not only were they charging me 1%, they were putting me in actively managed funds that had their own high expense ratios that varied anywhere typically from 0.8 to 1.5% in addition that I was paying. But I never knew that because those are hidden fees that are just surreptitiously taken out of my portfolio on a monthly or quarterly basis. And it wasn't until I think in 2008, around the time of the great financial crisis, I stumbled upon a column on Market Watch written by Paul Farrell called The Lazy Portfolios, and started reading about index investing there. And he was a big proponent of that. And I had kind of my first aha moment was, that's interesting because it's very low cost. I ought to look into that, which I did. Now, I decided ultimately to play around with that first to see how well it worked compared to my professional advisors. So I opened up my own brokerage account separate from the others that were actively managed and started putting money in and watching how it performed. And it was capturing the market returns. I ended up using what was called Bill Schulteis's coffee house portfolio, which was a basket of 7 or so index funds. And that's what I modeled this portfolio off of. And it did well. I continued adding to it. I put a little bit of money towards the advisors I was still using, but I started putting the majority of my money in my own brokerage account and learning. And after a while, I realized this is pretty good. I continued doing it, but I was fearful of dropping the advisors altogether. So I decided to kind of have a horse race and see how.
Let me actually just pause you right there, Alan, because you say you were fearful about firing the advisor. Do you mind mentioning why? What was that fear?
Well, one of the things was I had remarried. I've been married for 25 years happily now. And my wife was a novice for investing, and she was a little bit leery about my skills in managing our growing portfolio. And I wasn't entirely sure yet. I hadn't yet discovered the Bogleheads, mind you. This was just 2008. So I was still learning and educating myself and seeing what happened. So it was over a period of years that I finally got comfortable doing that and then deciding ultimately to switch over to total control of the portfolio using entirely index funds. So it was a learning process. And mind you, I was still very busy with my career, and time was a limiting factor as well. Plus, we had our 3 kids in total. So I figured let the advisors do what they do, and I'll see how well I compare. But after a while, it became quite evident that I was doing better because of the low fees. That was the key. And then in 2013 is when I discovered the Bogleheads community online, which I'm surprised I hadn't stumbled upon it prior to that. I knew who Jack Bogle was, but I hadn't given much thought to what his philosophy was. But I stumbled upon them and started really getting a real education then and reading the forum and the resources. And that's when I said, okay, we are going to transition completely over to totally a DIY index fund approach.
All right. And so, so let's now, all right, now we're getting kind of into the meat of things. You said that you heard of Jack Bogle, but for those who somehow may not have heard of Jack Bogle, do you mind just saying a little bit about Mr. Bogle's philosophy and who he was?
Sure. Well, Jack Bogle was the founder of Vanguard, and basically he's the one who really brought the concept of index fund investing to the masses. There had been an institutional fund that was doing index investing. I think it might have been Samsonite or something like that, but it hadn't been offered to the retail individual investor. And he came out with the S&P 500 index fund, which was, I think, the first one from Vanguard. He formed Vanguard and built, obviously, his whole legacy with the fact that index investing is probably the best way to achieve financial freedom and success. Now, interestingly, Vanguard still has a very large portfolio of actively managed funds as well. But again, the Vanguard's approach is to even approach active investing by minimizing expenses. Now, I'm not touting the virtues of Vanguard. I mean, you can do the same thing at Schwab, Fidelity, other brokerages. It's just the concept that if you do index investing with very low expense ratios and costs, long term, you'll outperform probably 85% of active investors and active fund managers. Over time, you continue to get better and better and do better than they do.
And actually, to back you up, Alan, there are reports from the S&P 500. I'm sorry, the S&P active index versus active or SPIVA reports that we've cited in prior podcasts which confirm exactly what you're saying, which is that over longer periods of time, actually not even tremendously long periods of time, 10, 15, 20 years, index funds or passive funds will generally do better than active funds, I believe around 90% of the time or so.
Right. Jack Bogle was famous for saying, don't try to find the needle in the haystack by picking the next winner. Just buy the whole haystack. And that's ultimately what works best.
And so that was Jack Bogle. Now, there were a group of folks who decided to follow his investing philosophy, and I think also added a bit to it, calling themselves the Bogleheads. Now, you're the Tampa Bay coordinator of the Bogleheads and also involved in other levels as well. But do you mind briefly mentioning who the Bogleheads are?
Well, it all started, I think they were called the Vanguard Diehards when we were strictly talking about Vanguard index funds on the Morningstar Forum. And for one reason or another, they outgrew the forum and decided to form their own separate entity called the Bogleheads Forum. And Taylor Larimore famously was one of the founders down in South Florida. He's now 102 years old, I believe, and incredible. Still posts on the forum from time to time. God love him. And he and some others, Mel Lindauer, and there were some other names, I'm sure, but a number of people got together, and they actually physically got together for a meeting down in South Florida with Taylor, and decided to grow the community and share the knowledge and wisdom that they had gained. And over the years, it's just grown into a worldwide endeavor with hundreds of thousands of individuals involved. It's one of the most active DIY investing forums on the internet, if not the largest. And it's expanded to include all local chapters, both domestically, a number that are worldwide, international. They have an annual conference. There's one that's coming up shortly in Texas. Unfortunately, I can't make that one. I'll be out of town. But they have annual conferences with people like Rick Ferry, who runs the Bogleheads on Investing podcast that he does, a monthly podcast, which is an excellent resource, and a number of other luminaries in the industry. They're not all related to Vanguard by any means. It's just the concept of index investing that they support. And it's just a tremendous community to educate one another. My goal in retirement is to try to educate the next generation, to keep them from making the same mistakes that I had to learn from.
And by the way, we'll have a link to the Bogleheads wiki in the show notes. I found it so helpful, and there really are all sorts of different topics that are addressed. And so I find it inspiring and educational, and I hope other listeners go and check it out as well.
By the way, I might add that all the proceedings from prior conferences have been recorded and are available for free. All the lectures and presentations are free at the John C. Bogle Center for Financial Literacy website, and there's also links on the Boglehead forum as well. And this year's conference, likewise, will be recorded and ultimately available for free online. It's much better to go in person if you can, to interact with everybody on a casual social basis, but great resources. And it's all available. Everybody is donating their time and volunteering their efforts. Nobody's getting paid for this.
Well, so let's actually talk about what I really wanted you to discuss as I invited you onto the podcast, which is the Bogleheads investing philosophy. And I've mentioned several times on this podcast, I personally probably am most inspired by J.L. Collins' The Simple Path to Wealth, and learning from him got me a little bit knowledgeable about the Bogleheads, and ultimately it's what led me to join the Tampa Bay chapter of the Bogleheads, which is how I met you, Alan. And I think the philosophies jive in many ways very, very closely. So the first one really is, it seems like it should be simple, but especially for doctors or lawyers, it's not so easy all the time, but live below your means.
Like I said, that's what I was doing that already. I just didn't realize I was becoming a Boglehead. But it just means, it's basically spend less than you earn and save the rest. And the key point there is to pay yourself first. By that, I mean, invest for your retirement first. Don't save what you don't spend. Instead, spend save for yourself first and for retirement and spend the rest if you want. But make sure you save for yourself first. Pay yourself first. That's the key.
You know what? And I've found that I found that for me, one of the easiest ways to do that is to automatically send things from my checking account on a periodic basis directly to an investment account or IRA or HSA or other thing like that. So that way, before that money goes towards bills or vacations or luxury items or stuff, you are literally paying yourself first before it goes out into those other avenues. And then you kind of learn to live below your means and keep things as check. That's at least been helpful for me.
Yeah, unfortunately nowadays, certainly for retirement plans, they typically default into something like a target date fund or something that's automatically invested for you. When I first started investing, it would just be sitting in cash, and you had to actively invest it in something. So that's been a huge step to help people achieve retirement goals by making it automatic. And plus, with the technology nowadays of investing, it's a lot easier to set up automatic deposits and have it directed to the proper accounts. And you can also save in a taxable brokerage account in addition, and certainly a Roth. There's a lot more options that are all excellent.
Absolutely. And let's go to the next point on the Boglehead's philosophy, or the next one we'll talk about at least, develop a workable plan.
I think that's key. Basically, you have to build a roadmap as to where you're going in your financial life. So you want to set your goals clearly in writing. Ideally, you want to develop something called an investment policy statement or investor's policy statement, IPS, that basically specifies what your asset allocation is going to be, what your goals are. And by putting it in writing, it'll keep you from veering off course. You're more apt to follow it and not make any rash decisions. Another famous saying from the Bogleheads is what's important is time in the market, not timing the market. So basically you just want to invest often, as early as you can, as often as you can, and stay the course, but have it written down on paper. And if you get the urge because of people trying to push you in a certain direction of the hottest new stock or tech or crypto, read your plan and think it through and don't make any rash changes. Stick with it, but put it in writing and involve your spouse or partner in the process, which is very important as well, to make sure you're both understand the values, share the values, and are committed to the plan together.
And the workable plan might have something like this is your specific asset allocation, regardless of what's going on in the market. This is the specific asset allocation, and that may also help if you get a lump sum of money that you're not sure what to do with or how to invest. Just look at your plan and it will tell you, okay, yeah, this is what I already pre-decided I'm going to do with my money.
Yeah, what I did in mine is I put in a time limit that I had to wait at least 30 days before I ever wanted to make any change to my asset allocation or buy a new investment, to give it some thought, to let it, basically sit there for a while and then decide if it really is something I want to do. And that's helpful. If you put it in writing, you've got to commit to sticking to what your rules are.
And I think that's especially helpful. You don't want to make rash decisions. I like that you kind of gave yourself that buffer, so you're not doing things based on emotions, but giving you that space to really think things out.
Yeah, let those ideas simmer a little bit before you act on them.
Mm-hmm. And you briefly mentioned this, but the next one is invest early and often.
Absolutely. That's the key. Probably more important than your asset allocation when you're starting off is just investing. Even if you don't get the asset allocation exactly right, the fact that you're investing, that will pay huge dividends down the road just by virtue of doing so. So invest as much as you can, as often as you can. And again, it's time in the market, not timing the market. It gives you a longer runway also to handle the volatility when things go bad. And the stock market is very volatile. You'll probably have multiple periods in your life where you may have a 50% loss temporarily. But the longer your runway, the longer time you'll have to recover. And the more you get used to the volatility and the fluctuations, the more you can sleep well at night and understand that they will in turn recover. So
talking about sleeping well at night, another part of the Boglehead philosophy is never bear too much or too little risk. What do you mean by that?
Well, that's a very key aspect, and perhaps the hardest one for individual investors to sort out, because you have to take market risk. You have to invest in equities, which are volatile, because you get the return for that, taking that risk. But you don't want to take too much risk and endanger your long-term security. So basically, there's the term which you can delve into perhaps on one of your other upcoming podcasts, is you want to decide or determine what your willingness, need, and ability to take risk is. I won't go into too much detail there, but those are important concepts to understand. In your early years, when you're just starting out in your career, you have a lot of human capital, and you have potentially a long runway of income, which helps provide some balance and security. So you can invest a higher percentage of your portfolio in equities when you're young, because you have your human capital to balance that out. But as you get older and farther in your career, you have less human capital, you have retirement approaching, you probably want to dial back the risk a little bit and adding in more fixed income, bond, some cash holdings, just to help offset some of that volatility. And finding that perfect balance between the risk and the fixed income holdings is important. But trying to figure out what that is, there are a lot of online risk quizzes you can take, but until you've lived through a bear market, recession, or God forbid a depression, you really don't know what your risk tolerance is until you're tested. So if anything, probably better to start off a little bit more conservative and wait until you eventually go through one of those periods and see how you react, and then you can dial up or down your overall risk allocation at that point.
And when you mention equities or securities, generally you're talking about stocks or better even yet, stock index funds, and fixed income generally is referring to bonds or other cash CDs, those types of things. Yeah,
safer holdings. Not necessarily safe, because bonds can also be risky, but not quite on the same scale as equities.
And by the way, in prior episodes, which I don't think are posted yet, but by the time that this episode comes on, they will be posted. We'll be discussing bonds, index funds, total stock market index fund, international index funds, and other options, which actually takes us to our next topic, which is diversify.
And that's another key aspect of this. You want to diversify your risk by having different geographic allocations, but not only domestic, but have international as well, some emerging markets ideally. And obviously for the younger folks over the last decade, the U.S. Domestic equities have outperformed, especially the large cap and large cap growth in particular. But it's not always been the case. At other times, international's done wonderful this year. It could be small and mid cap stocks that likewise have their period in the sun. So it's important to diversify away your risk and not focus on what's hot currently, because inevitably there's the concept of things reverting to the mean. And just because one sub-asset class, like large cap growth, outperforms for a period of time doesn't mean it'll always be so. So by basically trying to emulate the whole total world market cap, or at least have an appropriate diversification, including some international stocks, is important. For those who are curious, the approximate ratio of the world market is something like 70% or maybe 60% U.S. and 40% international, plus or minus, it varies. Always good to have a mixture of both.
And so diversify. So you shouldn't. It sounds like you're saying you don't necessarily need to chase the latest trends. Don't put everything in tech stocks or Bitcoin or what have you. That really your suggestion is to diversify, and it sounds like, especially within the Bogleheads community, amongst total stock U.S. stock market or S&P 500 international index funds and bond funds. That's kind of the ideal way that the Bogleheads think of it. Is that?
Yeah, that's the classic. What you describe is the classic 3-fund portfolio, which is basically just those 3 funds: total U.S. Stock fund, total international stock fund, and total bond market. But you can expand that a little bit, as I have done when I talk a little bit later about my asset allocation. I've played around with some tilts, but not necessarily designed to do that, but I had them in my portfolio because of the active managers, and I got stuck sticking with them because of the tax implications. But if you just keep it simple and start off with those three as the foundation, you'll have a pretty good portfolio to live with.
And another way to keep a pretty good portfolio is to keep costs low.
Absolutely. That's the key and what made Jack Bogle so famous, basically. He said, I think something to the effect of, in investing, you get what you don't pay for. Because if you're not paying your advisor, you get to keep it, and it grows, it compounds. And that's a key point. Again, people need to realize that when you're paying 1% or more fees, it's not just the 1% you're losing. You're also losing, it's an opportunity cost for that money that's being spent is not going to compound over time. And it's amazing how the exponential effect, how much impact it has, as we'll talk about in a little bit. So keeping costs low is key, keeping the expenses as low as possible.
And I think here's the interesting thing, and I won't belabor this too much because we're going to talk about it a bit more later, but I know when I heard 1% from a fee, I was like, oh, that's nothing. Of course, that's not a problem. Not quite understanding that in and of itself was 15 to 20% of the expected returns of a market, which would be 7% after taking into account inflation. So that 1% actually takes up a big chunk of your earnings.
Even more so in retirement. That's when I had my major aha moment, when I was already starting to invest and I had my advisors. I was starting to read about what's called the 4% rule or 4% rule of thumb by Bill Bengen, I think. Also the Trinity study that suggests as a starting point, you could take out 4% of your portfolio value your first year of retirement and then inflation adjust it every year thereafter. And it dawned on me, now wait a minute, if I can take out 4%, and that's with a balanced portfolio that should last over 30-year retirement, plus or minus. And I thought, wait a minute, if that's the rule of thumb and I can take out 4%, but I'm paying 1% to the advisor, that's 25% of my annual retirement money I'm giving to the advisor. How could that be? And that really kind of piqued my curiosity and caused me to do a lot more reading and research to see what the impact really was. And it's substantial.
It is, and something else that can be pretty substantial, taxes. So part of the Boglehead philosophy is minimizing your taxes. I guess the why is pretty obvious. Nobody likes to pay taxes, but how do you minimize taxes?
Well, firstly, index funds are relatively efficient tax-wise because there's not a lot of trading going on. So then, in and of itself, certainly in a brokerage account, is important because you want to minimize the tax drag, as it's called. If you have actively managed funds that are constantly buying and selling and switching around, there's embedded capital gains that you're going to have to pay taxes on annually. In a retirement account, it's less critical, but still, you want to keep your costs low so you have the maximal growth. So when it comes down to minimizing taxes, there's a certain amount of tax planning that goes into it. And that ties in to some extent with what's called asset location, basically. And the things that, and there's some great graphics. I know Vanguard has some. The Bogleheads have a great resource on their wiki for tax management and how to minimize taxes. And the things that are tax inefficient, you prefer to have in something like a retirement account, a 401k, an IRA, and so forth, where you're not being taxed as deferred taxes that you'll pay later on. Things that are tax efficient, like domestic and international index funds, particularly domestic index funds, are best to have in a taxable brokerage account. And then, of course, in a Roth, it's less critical because you're never going to pay taxes. It's all post-tax dollars. It takes, ideally, you probably want to work with a financial professional if you're not comfortable yourself, with your accountant if you use one, CPA. I suppose you could consider a tax attorney as well, because there are other more sophisticated tools you might want to take advantage of if you're ultra high net worth. But generally, you can do it on your own. It's just common sense, really, in terms of where to place the funds and let them run. Just basically set and forget your portfolio. Once you have it set up, just leave it alone, because ultimately, again, I think Jack Bogle was famous for saying that a portfolio is like a bar of soap, and the more you touch it, the less you have. So if you just invest in index funds, buy and hold, let it grow, stay the course is my hat says, with minimal tax impact. You'll be amazed, absolutely amazed, years down the road when you look at the value of the portfolio and how well it's done for you.
Yeah, and by the way, we'll be talking about asset location in a future episode and exactly what you're referencing, which is the tax efficiency of various different types of investments and where you may want to consider putting them. But you took us exactly where we were going next. I was going to make sure that the folks who could see the video saw your hat, which says "Stay the course" right on the front, and that's a big part of it. And that, it sounds easy to stay the course, but when markets go into crazy jumps and then tumbles down, that can be really challenging. But that's part of the Boglehead philosophy: stay the course.
Like they say, those who don't study history are doomed to repeat it. So everybody always says, well, this time is different when we have these market fluctuations. Yeah, it is a little bit different, but inevitably, the way the economy, the world's economy goes, companies are making money, they bounce back. And yes, there will be a lot of volatility, more so in the equity side of things than the bond side. And just understand, go back and read a little bit the history, educate yourself on what long-term performance and portfolio growth ends up with, and I think you'll be fine. You just need to be able to sleep well at night and understand what's going on and leave it alone and let the compounding work and get on with your life. Once you have the portfolio that's set up and according to your investment policy statement, add to it as often as you can, rebalance as necessary, maybe once or twice a year. You don't have to rebalance on a monthly basis, and go live your life. Let the portfolio do its thing and depend upon the growth of all the businesses that are working hard to make profits, and they're working for you as well as themselves.
And and so we've been talking about the different ways that the Bogleheads makes really investing easy and accessible for the average person, and certainly. I would suggest the lawyer members of the audience and really anybody to go check it out. Check out the philosophy. Again, we'll have the Bogleheads wiki in the show notes. But you actually brought a really interesting graphic which discuss the effect of fees, and you gave as an example a 1% annual advisory fee. As opposed to not having an advisory fee at all. And by the way, when we discuss keeping costs low, I mean, right now you can get funds like Vanguard's VTI or Charles Schwab's Total Stock Market Index Fund or Fidelity as well for 0.04 expense ratio, which really is just $4 for every $10,000, and that's the highest. That's the highest of those three. So I would just mention it's almost like barely paying a fee at all. But anyways, there's a difference that you have in the graphic that shows what that 1% will do over a 30-year period. Do you mind describing it for those who can't
Sure,
see it?
yeah, it's pretty impressive. You have to see it. I'm sure you'll share that in the show notes or otherwise. But for an example, this is starting with just a very small starting point. If you start off with $250,000 portfolio, and say you're going to have a 7% annualized return with that, which is not unreasonable for a relatively high, say 80% equity allocation or so. But it doesn't matter because the point is the same. That over 30 years, just having that without adding any more money to it, okay, over 30 years, that would basically appreciate to be $1.9 million. That's with no fee or minimal.
That's
fee.
the magic of compound interest, huh?
Right. But if you had a 1% expense ratio onto that, okay, you end up with $1.37 million versus $1.9 million. That's a $530,000 less. And that was just starting with $250,000. And the reality is that the loss is magnified more because you're going to be investing and adding to the portfolio over time and losing more and more and more because of the compounding of the fees. So this really illustrates how critical even that 1% expense ratio is. And anything you can do to minimize that will pay dividends down the road.
So just to sum that part up, it sounds starting off with a $250,000 portfolio, assuming a 7% rate, annual return, over 30 years, if you have an advisor or an expensive or an expensive fund charging you 1%, that could cost you $500,000 over 30 years. Wow.
And even more. I mean, the fact is that's also, and that would be if the advisor just used index funds and just charge you the 1%. Now, if they're using actively managed funds with their own embedded expenses that may be 0.5 to 1% or even higher on top of their own 1% fee, that's even going to double the loss. So it's extremely significant. You have to understand the math. And nowadays, again, fortunately with the internet and even with AI, you can model this out to really see visually what the impact is.
And so it sounds like this has been somewhat of a journey for you in terms of your investment philosophy. And I know that you've pointed me to Rick Ferry's Education of an Index Investor. And do you mind describing the different phases of that?
Sure. This is something that Rick Ferry, who hosts the Bogleheads on Investing podcast, came up with this, which I think it really explains my path quite well. It captures it. And there's 4 stages of the education of an index investor. The first one, I'll just read through. Their darkness, enlightenment, complexity, and then simplicity. Start off, as all of us do as neophytes, in the darkness stage, where we fall prey to the stock picking, market timing, active funds with high expense ratios, chasing the next big thing. Because we don't know. We think that we can beat the market, and all we have to do is pick the winner. And over time, once we get educated, we then get enlightened. That's the second stage, the stage of enlightenment. And that was, for me, one of these first aha moments when I first heard about index investing and discovered what the impact is and the effect of expense ratios and high fees. And you start to evolve into becoming an index investor. But following that, unfortunately, we tend to go to the next stage, which is complexity, because we understand it, we think we know more, we're educated, we're confident, and then we say, well, I'm going to start chasing a little of these sub-asset classes and try to do even better and try to beat the market. And I go down the rabbit hole by slicing and dicing the portfolio. You add things that advocate smart beta, alternatives, crypto, perhaps some more sophisticated real estate type holdings and so forth, trying to beat the market and thinking I can do better than a simple 3-fund portfolio, when in fact that just leads to regret down the road. And that's what happened to me when I ended up with an extraordinarily complex portfolio that I needed to unwind from to get back to emulate something like a 3-fund portfolio. The final stage, after you finally get through the complexity stage, is to end up with simplicity. And that's when I call it being the self-actualized Boglehead, when you realize that just very simply a simple, diversified, market-weighted portfolio is really all you really need. Just set it, forget it, stay the course, occasionally rebalance, and focus on living your life. And that's where I'm at. I'm transitioning from complexity to simplicity. I've been doing so for the past 10 years. I'm not quite there, but I'm pretty far along the way and quite happy with where I'm at, and glad that I can now spend more time enjoying my family, enjoying my other interests and activities in retirement. So Rick Ferry really nails it when he described those 3 or 4 stages.
So I have to say, we've all been waiting. We're excited. We've been waiting to hear what your asset allocation is, or at least your philosophy is on it. If you're comfortable, do you mind sharing?
Sure. Well, I sold everything, and I'm all in crypto now. Okay. Not at all. Not at all. It's interesting. I actually did a quick analysis in 2014. I went from 25 active funds with 15 individual stocks in addition and a bond ladder. Now I'm currently down, I whittled that down to 6 stock index funds and 3 bond index funds and 3 remaining legacy individual stock holdings. And when I retired, I had about a 50-50 portfolio. I had purposely made it a lot more conservative to eliminate or minimize what's called the sequence of returns risk, which I'm sure you'll address.
And I'm sorry, when you say, Alan, I apologize. When you say 50-50, you're talking about 50% stocks and 50% bonds, correct?
Correct. But now with the growth of the market and reallocating a little bit more as I wished, realizing I can be a little bit more aggressive with my risk tolerance, I'm currently at about a 67% equity allocation and 30% bond allocation and 3% cash, which I use for 1 or 2 years worth of expenses. I tried to emulate a 3-fund portfolio. I haven't been able to quite do it. I do have still some residual tilts. I have a little bit of a small and mid cap tilt, which is a side tilt. The ratio typically of large cap stocks, this is speaking domestically only, a U.S. total stock market would have roughly about 75% large caps, probably about 15% mid caps, and the rest in small cap allocation. And I have a little bit more. I probably have about 25 to 30% in small and mid caps, just because I'm willing to take a little bit more risk, as long term, particularly small cap value has done better long term. Doesn't mean it's going to repeat that type of history again. I also have a little bit of a value tilt with large cap value. My overall asset allocation as far as international goes, I'm 80% domestic and 20% international. This year I wish I was a little higher, and international has done quite well, but it's been lagging for many years. I also do have a 5% allocation to REIT index. I use the Vanguard REIT index. The reason for that is that a lot of real estate holdings are not necessarily reflected in the total stock market. A lot of it is privately held, and by holding a separate allocation to a real estate index, it gives you a little bit more exposure to that sub-asset class. It probably, performance is somewhat between an equity and a bond holding, and it fluctuates quite a bit, but it can help smooth the ride overall over time to minimize volatility.
And the REIT, that's a real estate investment trust. That's just another asset class that actually is talked about quite a bit by Jim Dolly and others in Bogle as well, in the Bogleheads.
Yeah, my overall expense ratio, I believe, is about 0.06%. 6 basis points.
So you're living your word. You're keeping costs low.
Absolutely, and that's paying off so far.
Well, I'd like to now switch gears, if it's okay. Because we do have an audience that's mainly attorneys, but I think other folks listen as well, doctors, business owners as well. Do you think that there are challenges, especially for doctors, in keeping this type of Boglehead philosophy?
Well, I think anybody can do it. They just have to tune out the noise. Unfortunately, with internet and social media, there's so much noise, so many people trying to get your attention, and Wall Street is trying to extract your money and put it in their pockets. So it doesn't matter. You don't even have to be a high income professional. And I wasn't. By the way, when I worked, the majority of my career, I was an employed physician being paid below market rates. Okay, it's not like I was an extraordinarily highly compensated physician. I was not, but I chose, again, having been divorced, I wanted to remain in my geographic area to be near my daughter, and I gave up a lot, but that's fine. If you just embrace the philosophy and stick with it, regardless of whether you're a high earner, an average earner, or even a low earner, and it's probably even more important, the lower you are in your earning capacity, it's more important to keep costs low and embrace something like this, because you don't have as much wiggle room to overcome the costs, and just to continue doing it. And there'll be a lot of pressures from your peers, from other social interactions you have, and certainly from CNBC and the like, and social media, trying to coerce you to chase the next hot thing and extract money from you. And you just have to ignore it, tune out the noise, and stay the course.
Yeah, I found that as lawyers, from this perspective, oftentimes we think because we're really smart and really good, or at least we think so on both ends, on our particular area of practice, that we've got to be pretty smart investors as well. So we can outsmart, the market or other things. As we mentioned earlier, there's studies on this kind of thing that the higher costs and more active funds generally means you're making less money, 90% of the time. In fact, I believe there's an inverse correlation between the cost of these types of funds and investments and the actual outcome. The less cost you pay, the more you're probably going to end up with.
Well, that's absolutely true. And I think anybody who's, academically focused, they think, well, the more I study, the better I'll do. That's not necessarily the case with investing. Actually, if you keep it simple, you'll do better. And that's a fallacy, that if we think, we can outsmart the next guy. And the people that you're really competing with is the geniuses on Wall Street, who are the PhDs, who have the fast computers and the capabilities to do the analysis. The ones that are basically, doing price discovery and so forth, and deciding what fair value is, and trying to outsmart the market. You can't outsmart them. But overall, long-term, as you've alluded to, long-term, just accepting the market return will ultimately make you better and give you better returns than 85-90% of the active managers. So don't try to outsmart the market. Don't think you're better or smarter. The smart people say, I don't know enough to compete. Charlie Ellis wrote a book, I think called Winning the Loser's Game, or Losing the Winning Game, whatever it's called. It expresses that concept. But basically, let the market do its thing, and don't think you're special. Don't go trying to chase special products that you think you, as a higher income or higher net worth individual, have access to. Yes, there are people that are going to sell you those products, more than happy to, with relatively high expenses and or commissions, because it benefits them. But just as I said, tune out the noise and just keep it simple, and you'll succeed.
Going back to, we'd mentioned Jim Dolly, Dr. Jim Dolly of the White Coat Investor. One of the things he likes to say is there are certain investments out there that are meant to be sold, but that are not meant to be bought, meaning that they're only benefiting the people who are selling them. They're not necessarily, they're not helping you.
Right. I mean, fortunately, there are some other excellent resources out on the internet and in forums nowadays to get an education. If there's a specific product or concept you want to explore and learn about, that's fine. I encourage you to do so. The Bogleheads forum and wiki are phenomenal. All the YouTube videos from the annual conferences are very helpful. Morningstar has some great content. Lots of wonderful people out there that are trustworthy, along with Rick Ferry, Mike Piper, Christine Benz through Morningstar and through her work, currently the president of the John C. Bogle Center. So Alan Roth and other luminaries that are all honest and have great content to share and help educate you. So, Rob Berger's another one. Be careful though. There's a lot of charlatans out there. So you have to separate the wheat from the chaff.
So as we're bringing this to a close, I just wanted to check with you, Alan. Is there one piece of advice that you might have for the lawyer listeners and other professionals when it comes to investing?
The most important thing is start early. That's the key. And stay the course with investing on a regular basis. As we said before, pay yourself first towards retirement. That's the most important thing. And as long as you're doing that, then you're buying time to get educated on the other nuances that you need to know about. But if you say, I'm going to wait, I'm going to have all my cash sitting aside while I try to pick out the next winner and decide what to do with it, you're wasting time. put it to work, ideally with low-cost index funds. And if you want to dabble with 5% of your portfolio in the more riskier stuff, and whether it be crypto, actively managed funds, individual stocks, hey, go to town, have yourself a ball, but put 95% of it into low-cost index funds, and regardless, you'll be fine.
Well, excellent. And by the way, if you're a listener and you haven't started yet, now is early compared to later. So just get started now. That's the only thing I would probably add to that. Alan, anything else you'd like to say?
No, thank you. I appreciate you inviting me to be on your podcast, and I hope this is useful. I encourage everybody to explore the information further, and certainly explore what you have to offer on your channel and the podcast. And it's all good, useful information, and you will benefit from it and appreciate it down the road when you one day look back on your investing career and then look at your portfolio and go, oh my God, I cannot believe I achieved this. Incredible.
Well, Alan, thank you so much. It was an absolute pleasure. And I think you brought an important message for our audience. So thank you so much. And I look forward to seeing you at the next Tampa Bay Bogleheads chapter meeting.
Certainly. I look forward to seeing more from your content.
This episode of the LawyerFi Podcast is sponsored by Family Diplomacy, a collaborative law firm. If you're facing divorce in Florida and looking for a private, humane alternative to a courtroom battle, such as collaborative divorce, give us a call at 813-443-0615 or visit us at familydiplomacy.com. We accept clients in every county in Florida, and we have offices by appointment in Tampa, St. Petersburg, and Sarasota. Remember, you're not alone. We can help.
This has been the LawyerFi Podcast. Visit our website and learn more at LawyerFi.com, including information about how to become a sponsor. Watch or listen to us on YouTube, Apple Podcasts, Spotify, and anywhere you get your podcasts from. You can also reach us on Facebook, Instagram, TikTok, and LinkedIn. LawyerFi is hosted by Adam B. Cordover and produced by Eric Sachs. Original music is by Jake Biller. Adam B. Cordover is a Florida-based collaborative family law attorney. He is not a financial advisor, accountant, or tax attorney. This podcast does not provide legal, financial, or tax advice, and is for information and entertainment purposes only.